Welcome to Chapter 5, the cost of fund ownership. Costs may be the least glamorous part of investing, which is exactly why they are so useful. Future returns are uncertain. Fees have the courtesy to tell us in advance that they are coming. This chapter goes beyond the expense ratio. We will trace management and operating expenses, sales loads 12B1, and platform payments, trading friction, taxes, account fees, and the cost of poor investor behavior. We will also compare share classes, examine breakpoints, and ask what a higher cost strategy must deliver to justify the larger hurdle. The point is not that the cheapest fund always wins. A low-cost bad fit is still a bad fit. The point is that every additional basis point needs a job. Fees are quiet, persistent, and impressively punctual. They do not predict the market. They simply show up and compound. 1 percentage point sounds small when it is printed in a fee table. Over 30 years, it is not small. On the slide, $100,000 earns a 7% gross return. With an annual cost of just 0.05%, the ending value is about $750,626. With a 1% annual cost, the ending value falls to roughly $574,349. The difference is about $176,000. Before trading costs, taxes, advice, or investor mistakes, the fee does not arrive as a dramatic invoice. It is removed quietly from assets, leaving less capital to compound next year. Compounding is an equal opportunity machine. It works for returns, and it works just as efficiently for costs. 1% can look like spreadsheet dust until it grows into the price of a house. This chapter develops 4 practical skills. First, decompose, identify which costs belong to the fund, the shareholder, the account relationship, portfolio trading, taxes, and investor behavior. Second, calculate. Translate percentages into dollars and estimate how expense differences and sales charges affect long-run wealth. Third, evaluate. Compare share classes, breakpoint eligibility, advisory arrangements, and active versus index economics using the investor's actual purchase amount and holding period. Fourth, govern. Explain how the fund board reviews management fees and how advisors must identify and manage compensation conflicts. Notice that the arithmetic is only part of the work. The harder question is whether the investor receives something valuable in return. A fee calculation can be perfectly accurate and still miss the wrong share class, a temporary waiver, or a duplicated advisory charge. By the end, you should be able to explain the complete economic bargain, not just quote the expense ratio. 4 connected questions organize the chapter. First, what are the visible costs? These include the expense ratio, management fee, 12B1 fee, sales loads, and account charges. Second, what are the implementation costs, spreads, commissions, market impact, turnover urgency, and cash drag can reduce return without appearing in the prospectus expense ratio. Third, what are the tax costs, income character, capital gain distributions, turnover, and account location can change what the investor actually keeps. Fourth, what is the value test? What service, access, risk control, tax management, or expected return must a higher cost purchase? The sequence matters. We first find every layer, then quantify it, and only then decide whether the price is reasonable. Looking only at the expense ratio is like reviewing a restaurant by the entree price and ignoring the drinks, tax, tip, parking, and the friend who ordered the lobster. Total investor cost is a stack, not one percentage. Start with the gross portfolio result, then subtract the management fee and operating expenses for administration, custody, transfer agency, audit, legal work, board oversight and reporting. Add distribution and service payments, including 12B1, sub-transfer agency, platform, and intermediary compensation. Then consider shareholder charges, such as loads, redemption fees, account fees, and advice level charges. Trading adds spreads, commissions, market impact turnover, and cash drag. Taxes and behavior complete the stack through distributions, realization, poor timing, and performance chasing. Some costs are disclosed in one place. Others depend on the channel, account, and investor. This is why a fund with a low expense ratio can still be expensive to own, and a higher cost relationship can sometimes create value if it provides real planning or behavior support. The prospectus gives us an essential number. It does not give us the final bill. The expense ratio allocates recurring operating costs across fund shareholders through net asset value. The advisory fee pays for portfolio management, research, risk, trading oversight, and often part of administration. Other expenses support financial reporting, regulatory filings, legal coordination, transfer agency, custody, fund accounting, audit, directors, insurance, registration, and shareholder communications. A 12B1 plan may pay for distribution or ongoing servicing, subject to board oversight. These functions are real. A fund does not calculate its own net asset value by positive thinking, but investors should distinguish necessary operations from an inefficient cost structure. Also watch expense waivers. A waiver can make a new or small fund look inexpensive today, but it may be contractual, voluntary, temporary, or subject to later recoupment. The net expense ratio is the current sale price. The gross ratio and waiver terms tell us whether the sale has an expiration date. Loads and ongoing fees create different cost patterns over time. A front-end sales charge reduces the amount invested on day one, but breakpoint discounts, rights of accumulation, and letters of intent can lower that charge. Class A shares often pair the upfront cost with lower ongoing distribution expenses, which may become more attractive over a long holding period. Other classes preserve more initial principal, but may charge higher 12B1 or service fees each year, and some impose a contingent deferred sales charge if the investor exits early. Advisory and platform fees can sit outside the fund entirely. Conversion features can also change the long-run comparison. The alphabet on the share class is not a quality rating, it is packaging. The correct class depends on purchase size, holding period, channel, eligibility, and services received. A seemingly painless annual fee can become expensive through compounding, while a large upfront charge can be a poor bargain for a short holding period. Breakpoints reward larger qualifying relationships, but only when the relationship is recognized correctly. The process begins by identifying the fund family, share class, eligible accounts, and household relationships. Next, aggregate existing qualifying holdings through rights of accumulation. If the investor reasonably expects future purchases, a letter of intent may allow those planned investments to count toward a breakpoint. Then apply the correct sales charge schedule, document the evidence and customer instructions, and supervise transactions for missed discounts. Operational failure here directly harms the investor. The lower charge is not a courtesy from the representative. It is part of fair treatment when the investor qualifies. This is one of the rare moments in finance when your family tree may be worth actual basis points. The compliance lesson is straightforward. Gather complete account information, understand each fund family's rules, retain evidence, and test whether the discount was actually delivered. The management fee is reviewed through a governance process, not a simple low price contest. The board considers the nature and quality of the services, including research, portfolio management, risk controls, operations, and shareholder support. It examines performance relative to the fund's objectives, benchmark, and relevant peers. It reviews advisor profitability and the assumptions used to allocate costs. It asks whether asset growth created economies of scale that should be shared through fee breakpoints or other reductions. Comparative fees for similar funds, institutional accounts, and sub-advised mandates provide context. The board also considers fallout benefits, such as distribution relationships or research arrangements. A fee can be reasonable without being the lowest, but the record must explain why. Sorting a fee table from low to high is not governance. On the other hand, we have always charged this is not analysis either. The process must connect price to service, scale, conflicts, and shareholder value. Fund fees remain near historic lows on an asset-weighted basis. In 2025, equity mutual funds averaged about 0.40%, bond mutual funds about 0.36%, index equity mutual funds about 0.05%, and index equity ETFs about 0.14%. Asset weighted means the largest funds receive more influence in the average, so the statistic tells us where investor dollars are concentrated, not what the typical product on a shelf charges. The index mutual fund figure also reminds us that an ETF is not automatically the cheapest wrapper. Institutional and retirement plan mutual fund shares can be extremely inexpensive, while specialized ETFs may charge more. And the broad trend is clear. Investors have migrated toward lower cost products, and scale has compressed fees, but dispersion still matters. Averages can hide expensive share classes, niche strategies, small funds, and account level charges. Never mistake an industry average for the investor's actual invoice. Distribution has shifted decisively toward no-load funds without 12B1 fees. In 2000, those products represented about 46% of long-term mutual fund gross sales. By 2025, the share reached roughly 92%. That is a major structural change, but it does not mean distribution became free. Advice, platform access, record keeping, servicing, and account administration increasingly sit outside the traditional sales load structure. A broker may advertise a zero transaction charge while the investor pays an advisory fee, wrap fee, platform economics, cash spread, or another account level cost. The commission wars changed where revenue appears. They did not persuade financial firms to take a vow of poverty. The useful question is not simply, is this fund no load? Ask who provides access and service, how each party is paid, what conflicts the payment creates, and whether the investor is paying twice for overlapping functions. Trading cost grows with turnover, spread, market impact, delay, and urgency. It is normally not included in the expense ratio, but it directly reduces portfolio return. The implementation shortfall framework compares the paper return available at the decision price with the return actually realized. Part of the gap is the bid-ask spread. Part is market impact caused by the fund's own order. Delay matters when the market moves, while the trade waits or is staged. Opportunity cost arises when the desired position is never completed. A high turnover strategy can still be rational, but its expected edge must exceed the full implementation burden. This matters most in smaller stocks, less liquid bonds, stressed markets, and crowded trades. A fund can pay zero stated commission and still execute expensively. Free trading is one of finance's more successful phrases because the market impact politely avoids sending a separate receipt. Tax cost depends on both the fund and the investor's account. Interest, qualified dividends, non-qualified dividends, and tax-exempt income can receive different treatment. Portfolio turnover and redemption management affect when gains are realized and distributed. A fund can make a capital gain distribution to an investor who bought shares late in the year, which is an unpleasant way to discover that the tax calendar and the purchase calendar are not friends. Loss harvesting can offset gains inside the fund, but the fund's tax position is separate from the investor's personal tax lots. Tax location also matters. A strategy that generates ordinary income or frequent realized gains may fit better in a retirement account than in a taxable account. Certain ETF in-kind redemptions can reduce capital gain distributions, although selling the ETF can still create a taxable gain. Pre-tax return is useful. After-tax wealth is what the investor gets to spend. A higher cost fund must buy something valuable. Potential value includes a credible security selection edge, better downside control, access to capacity-constrained markets, tax management, customization, planning, service, or behavior coaching. The common leaks are just as important. Closet indexing charges active fees for benchmark-like exposure. Duplicated advice and platform charges make the investor pay twice. High turnover can consume an edge that looked attractive before execution. The wrong share class or a missed breakpoint creates avoidable cost. Complexity also has a price when neither the advisor nor the investor can monitor or explain it. Cost should not be evaluated in isolation, but every additional basis point raises the burden of proof. Paying a premium for genuine skill or useful advice can be rational. Paying steakhouse prices for a benchmark sandwich is harder to defend. The decision's expected net value, after all fees, taxes, trading friction, and implementation risk. This case shows how a compensation difference can turn a share class recommendation into a fiduciary conflict. Under the SEC's Share Class Selection Disclosure Initiative, advisors placed some clients in mutual fund classes that paid 12B1 fees when lower cost classes of the same fund were available. The portfolio did not change. The invoice did. The advisor or an affiliate received more compensation, creating a conflict that was not adequately disclosed or addressed. A sound process identifies the conflict, compares every available class, verifies eligibility and platform access, and documents total cost. Disclosure must be specific enough to describe an actual conflict, not hide behind a generic statement that compensation may be received. Policies, surveillance, reimbursement, and class conversion can remediate harm and reduce recurrence. Suitability alone is not enough when a fiduciary chooses among economically similar alternatives. The investor deserves the class that fits the relationship, not the class that pays the relationship. Use this worksheet to turn scattered disclosures into one total cost decision. Start with the fund expense. Record current net and gross expense ratios, the waiver terms, and whether the lower rate is likely to persist. Next, list sales, distribution, platform account, and advisory charges. Estimate trading friction from turnover, spreads, market impact, cash drag, and derivatives implementation. Then examine taxes through distribution history, turnover, account location, and expected realization. Add time, purchase size, holding period, breakpoint eligibility, rates of accumulation, letters of intent, and conversion rules. Finally, state the value. What service, access, risk control, tax management, or expected alpha must justify the price. Convert basis points into dollars whenever possible. 50 basis points on $250,000 is $1,250 in the first year, before compounding. Percentages become much more interesting when they arrive wearing dollar signs. Now apply the framework to 3 ways of buying the same portfolio. The investor plans to invest $250,000 for at least 10 years and already has $150,000 of qualifying family holdings. That may create a $400,000 relationship for rights of accumulation purposes, but the exact breakpoint schedule must be verified. Class A charges a reduced front load and a 0.65% expense ratio. The advisory class has no load, but its 0.40% fund expense plus a 0.75% advisor fee creates a 1.15% annual relationship cost before other items. That is 50 basis points more each year than Class A after the load. The institutional class costs 0.30%, but is available only through the employer plan, so access may decide the question. pause the video. Calculate the break even, identify the services received, and state which missing facts could change your recommendation. Pause the video and answer the 4 questions on the screen. First, which cost is normally included in the fund expense ratio? Second, what is a breakpoint designed to do? Third, why can a low turnover fund be more tax efficient? Fourth, what is the strongest reason to pay a higher fee? Commit to your answers before continuing. Here's the key. Management and fund operating expenses are reflected in the expense ratio. A breakpoint reduces a front-end sales charge when qualifying purchases or aggregated holdings reach specified levels. Lower turnover can mean fewer realized capital gains and therefore fewer capital gain distributions, although flows and portfolio events still matter. And a higher fee is rational only when credible expected value exceeds the full incremental cost. A longer fund name, a recent advertisement, or an impressive minimum investment does not count as value. The purpose is not to memorize fee vocabulary. It is to recognize the economic logic automatically. Carry 6 claims into the next chapter. First, cost compounds. Small annual differences can become large wealth differences over long horizons. Second, the expense ratio is partial. Channel, trading, tax, account, and behavior costs may sit elsewhere. Third, share class matters. The same portfolio can deliver different net results through different packaging. Fourth, scale should be tested. If asset growth lowers unit costs, the board should evaluate how shareholders participate in those economies. Fifth, low cost is a hurdle advantage. A higher cost strategy needs stronger evidence of durable value. Sixth, compensation conflicts require specific disclosure, supervision, and a defensible recommendation. A basis point is tiny, but basis points travel in packs and they compound. In Chapter 6, we move from the cost hurdle to the active manager's challenge, researching stocks, constructing a portfolio, and trying to earn enough alpha to clear that hurdle after expenses. This final slide is the source register for Chapter 5. Posen and Hamaker provide the conceptual architecture. Investment company Institute Research supplies the current expense and distribution trends. FINRA resources support breakpoint analysis and fund cost comparison. SEC materials explain mutual fund fees and the share class enforcement case, while IRS guidance supports the tax discussion. There is no need to narrate every web address. The important habit is to distinguish primary sources from marketing material and to check the date before reusing a fee, rule, or industry statistic. Expense ratios, waiver terms, share class availability, tax rules, and platform arrangements can change. The discipline should not. Identify the full cost stack, translate it into dollars, and demand evidence for every incremental charge. The next module is Chapter 6, Portfolio Management of Stock Funds, where we ask whether active research and portfolio construction can produce value after the costs we have just measured.